Hello everyone, my name is Louis Baumier. I'm the Executive Director of the Institut de l'Énergie Trottier at Polytechnique Montréal. On my name and on behalf of Natural Resources Canada, I want to welcome you and thank you for joining us this afternoon for this other webinar hosted in the context of the Energy Modeling Initiative. So a few words about this initiative. This is it's sponsored by Natural Resources Canada, like I just said, with the aim of, well, we could summarize it in 3 words. It's maintain a dialogue between a network of modelers and also model users, with the objective of creating, fueling the reflection on what kind of platform should we put in place in Canada so that we made those modeling capacities easily accessible to decision makers and policy makers. If you want to know a bit more about what kind of proposition we made last year in terms of what structure should be put in place, I invite you to visit the website. There's a section with all the reports that we have been producing last year in this first year of the reflection. A few housekeeping notes before we start the presentation. The webinar should last for around an hour. There will be a Q&A session at the end. It will be recorded and the slides will be made available in the days after this webinar on the website of the initiative. So during the presentation, I will ask you to keep your microphone on mute, and you can use the chat function to type your questions or comments. And during the Q&A, I will go through those questions in the chat, but you're also invited to raise your hand using the feature in the interface to ask a question, and I will call your name as I find who is willing to ask a question. So today we have the privilege of having the 2 great gentlemen that will talk to us about a project, or the presentation will be presenting some of the things that have been done in the context of the Frantic project. A quick bio notes on our 2 speakers. First, we have Jean-François Mercure. He's a senior lecturer in global systems at the Global Systems Institute at the University of Exeter in the UK. His research focuses on developing models and methods for public policy appraisal in low carbon innovation based on complexity science, and for assessing the macroeconomic impacts of diverse types of low carbon energy and climate policies. He also developed methods to understand and assess climate-related financial risks. He is project director for the £4.8 million UK government commission project, Economics on Energy Innovation and System Transition, which promotes the use of complexity economics thinking to inform policy making for accelerating the low carbon transition in India, China, Brazil, the UK, and the EU. Our second guest today is Gregor Semieniuk, Assistant Research Professor at the Political Economy Research Institute and the Department of Economics at University of Massachusetts, Amherst. His research focuses on the energy and resource requirements of global economic growth, and on the political economy of rapid structural change required for the transition to a low carbon economy. He also he has consulted for the United Nations Environment Programme and the UK government on policies spurring low carbon innovation, and has won grants to study financing renewable energy supply deployment, as well as transition risks for financing. So without further ado, I will pass the control of the screen to those gentlemen and thank them again for accepting our invitation today. Gentlemen, the floor is yours.
Okay, is that good? Yeah.
Yeah, it's all looking good on my side. Thank you.
Thank you very much, Louis. Hi, everybody, and thanks for coming and attending this talk. Hopefully you find this interesting. So as mentioned, I'm from the University of Exeter. I actually am from Montreal, and I studied at U of Montreal all these years ago, but then been in the UK for a long time. And here's our team. Some people in Exeter, some people at Cambridge Econometrics, a consultancy, some people at the University of Cambridge, and I'm also affiliated there. We have colleagues doing climate science at the Open University, and there's Gregor, who's at University of Massachusetts Amherst, who was at SOAS before. Some of our funders are here. And this project was funded by what's called the Natural Environment Research Council of the UK, so-called the Frantic Project. So that was funding for fundamental research on financial risk. And the project is finished now, and the research keeps going with this new project called the Economics of Energy Innovation and System Transition, which is funded by the UK government directly, the Department for Business, Energy and Industrial Strategy, and we have a large team of researchers all over the world, actually. I'll begin this presentation with this graph, taken directly from a report from the Bank of England from 2018, and this is a discussion that started around 2015 when Mark Carney was the governor, and the bank created this definition for financial risk in relation to climate change, defining physical risks, which are risks related to weather-related events, and transition risks, which are risks related to the rapid transition towards a low-carbon economy. And I'll focus on transition risks here, and with particular focus on stranded fossil fuel assets. And this is work we've spent a lot of time doing in recent times, and this is what the Frantic project was focusing on. So I'll talk a bit about our method, and you can ask more questions at the end about how we do this. And I'll focus on talking about the energy geography around the world and how this is evolving at the moment. And then I'll talk about the political economy of the energy transition as it is unfolding. And I'll zoom in a little bit on Canada specifically in this presentation, because lots of things happen there in the way we model this. Okay, so what we're trying to do is to sort of gather a picture of the evolving energy landscape across the world in order to be able to explore what could happen in different countries and what could be different pathways for decarbonizing, but also what could be the impacts on the economy of those decarbonization pathways. And I'll focus on the real economy, while Gregor, who will speak after me, will focus on the financial sector, because lots of things happen there, as we will show. So this is the model here that we use. Now, this is a model that's used for policy appraisal quite widely at the European Commission, as well as in for different other governments. The UK government, we've worked with people in Japan, for example, in Korea. So what we have is this core economic model that is a global macroeconometric model. It's a demand-led model of the economy. So we estimate the demand for goods and services in many sectors, 43 sectors, sort of disaggregation, and 61 countries or regions of the world, and estimate intermediate production and final production and so on. And in order to estimate greenhouse gas emissions, we look at modeling technological change, that is technology diffusion, in a number of carbon-intense sectors of the economy, such as power generation, road transportation, and look at energy used by those sectors. We have a very detailed modeling representation of natural resources globally, that is oil and gas and wells and coal mines, with a huge amount of detail from a database called Rystad. And then we make arbitrary choices of policy assumptions in every one of the countries of the model and derive pathways for greenhouse gas emissions. And we put this into our own climate model of intermediate complexity to look at what that looks like for the climate outcomes. So this is the traditional approach we use for this model to do policy appraisal for climate policy with different governments. But in this particular project, we did something slightly different, which is more looking at the change in policy and technological change leading to changes in the energy sector, which of course causes changes to climate change, but primarily we're interested in the distribution of fuel production and the distribution of changes in the energy sector globally to look at macroeconomic impacts and financial impacts, and the financial impacts are discussed by Gregor after me. Okay, so now I'm going to try to draw a picture of how the world's currently evolving according to what we see in the data with this model. So I'm going to first draw, well, I'm going to draw 4 scenarios. And the first scenario is going to be a hypothetical scenario that I will call the investor expectations, because it's drawn directly from the International Energy Agency. And it's a very typical baseline with a 3.5 degrees of warming that comes out of the climate model, except that we don't think this is a scenario that's likely to materialize. In reality, if we look here in this model with a huge amount of detail at the direction that technology is taking in its diffusion, so the rate at which solar panels are appearing, the rate at which electric vehicles are appearing in many places, and we see something quite different that has a median warming of 2.6 degrees. So that's a big change. Now, recently, many countries have announced some net zero targets, and I'm not going to cover all of them, but we did include a number of them because that's starting to look very important and really tangible, in that there's the UK, France, the EU as a whole, Japan, Korea, and China have net zero targets. And if these were to be achieved, in fact, we may well reach a 50% chance of not exceeding 2 degrees, which is not Paris compliant yet, but is nevertheless an important transformation in the energy sector. And lastly, well, I'm giving a scenario of net zero globally that reaches 50% chance of not exceeding 1.5 degrees. Okay, so let's look at these things. So I've got the 4 scenarios here as columns, and I've got in horizontal rows 4 sectors taken out of the model. Of course, we model every sector, well, 43 sectors really independently. I'm showing the ones that are really technologically relevant, let's say, for emissions, but of course we cover much more than that. So I've got power generation, road transportation, household heating, steel making, and at the bottom there's a row where I'm showing global CO2 emissions from industrial and energy use origins. Now, the investor expectations at the left, that's what the IEA thinks is coming, and that's what we think many investors perhaps think is coming, a rising market for fossil fuels globally. But now if we look at the TDT, the technology diffusion trajectory, now if we look carefully at what's going on with solar panels everywhere, and we believe the current rates of diffusion of solar panels, that would take a very large chunk of the energy markets in the coming decades. And there's a similar thing happening with electric vehicles, and there's also some slow transformations happening in household heating and not too much in steel making. And of course, in the EU East Asia net zero scenario, so sort of halfway net zero scenario, we see a lot more of that. And of course, in the global net zero scenario, then everything has to become electricity based and renewables based. So that's sort of by construction, this would arise. So here we force the model to reach that. But what I'm interested in here is the flows of energy and how that's changing in those scenarios. So in the investor expectations, you would imagine that the markets are rising for the 3 fossil fuels. So here I'm showing fossil fuel supply at the top and renewable supply by source of resource. And after that, I'm showing fossil fuel supply and demand according to different regions. Of course, I've aggregated the 61 regions in those groupings here, and then renewables supply by region. Now, in the investor expectation scenario, perhaps we might expect that fossil fuel markets are still growing, but in the current trajectory, they are not really growing. In fact, they could be peaking pretty much immediately or very soon, and a sort of stagnation after that. And with additional policies and pledges, then really fossil fuels are peaking and declining. And I would just draw your attention to the distribution by region of the production of fossil fuels. Now, currently, of course, the consumption and the production of fossil fuels is that those geographies are very different. They are major exporters and major importers. But as fossil fuel markets peak and decline, of course, those exports gradually disappear. And that really makes big changes to the trade balances of all of these countries. Also because the renewable supply is primarily consumed where it is produced. There's not anywhere near as much trade of electricity as there is trades of fossil fuels. Now that's going to change the trade balances globally. So this is what I'm interested in. So I'm going towards the political economy of the energy transition. So many of you in studying energy systems will be well aware of this sort of hierarchy you have in oil and gas markets and production methods that have different levels of complexity and technical sort of complexity and costs of extraction. And it's quite clear that if there's a peaking and declining of fossil fuel markets to come, then you would expect that the more technically difficult types of extraction would disappear first. And that's quite visible in the data that we have. So this is the Rystad dataset that documents 120,000 extraction sites for oil and gas worldwide. So almost all of the world's production of and existing reserves and resources of oil and gas. And I've organized them here in histograms of quantities against their break-even price. That is the price the oil price has to be at for these to be profitable to extract. And what's immediately visible is that the Middle East has resources available at costs that are impossible to beat by any other region of the world. In fact, most regions are not very competitive, except currently most regions are producing and prices are quite high. But the second thing to know about this is that the expected demand in all scenarios except the investor expectations scenario, those quantities are similar to what's available in the Middle East. This implies that if people in the Middle East come to the realization, which I think is probably happening now, that the expected demand will more or less correspond to what they've got. If they want to maximize return on what they have as reserves, they had better put them on the market quickly. So there's a good chance that they decide that it's their fossil fuels that get sold and not other countries. So for that, we've done some scenario refinements where we look at the allocation worldwide of production according to different decisions taken for production by different players, and OPEC in particular. So OPEC may want to maximize return on what they've got. So we've created two scenarios. At one end, OPEC decides to have quotas that follow the demand proportionally as it peaks and declines. And the other extreme scenario is where they decide to not cut production and let other countries cut instead and keep producing while the demand peaks and declines. So that gives two extremes of what we could see happen in global fossil fuel markets. And this is what we get. So here I'm showing always to the left is the quotas Q scenario, and to the right is the sellout SO scenario. And at the top, I'm showing prices. Now the prices we simulate by determining the marginal units that's being sold in the market at every time step, according to the Rystad data. So what's the cost of the most expensive resource extracted? And if there's a lack of demand, then it's lower and lower cost resources that are required to supply the demand. So I'm showing in the lower panels the EU East Asia net zero scenario. I'm showing this because it seems like quite a likely scenario to develop, and especially the sellout version SO to the right. But you can see the difference. So you've got losses of outputs for oil and gas as percent of the present day, as percent of the production in the investor expectation scenario. And you can see Canada and the US at the bottom, and that's an issue to do with competitiveness in comparison to the Middle East, really, in terms of production costs. And it's quite clear that the Middle East is able to produce quite as much as they like, while forcing other countries to cut their production if they wish to do so. So now that's going to lead to quite important losses in terms of revenues for different countries and different companies. Now that topic I leave to Gregor, but I'm just going to do a quick quantification here. So imagine that I take expected outputs and expected price of fossil fuels, and I compare that to realized outputs and realized price of the same. And I take both multiplied and summed and discounted to the present. I can calculate the total loss of revenue per country, or even per company, or per region. And if I do this quantification, this is global here, and this is a comparison of every scenario against every other scenario that we've got. Just to give an order of magnitude, we see that these losses range in the trillions. So these are trillions, these numbers, 4 to 12 trillion at 6% discount rate. If we don't discount them, it's 7 to 19. And I draw your attention to this region, which is the EU East Asia scenario. So if China, Japan, Korea, plus the EU decide that they decarbonize, these are the amounts of fossil fuels never sold and never produced. And this is the same here for the global net zero, so up to 12 trillion roughly. Okay, so decarbonization has different impacts on the real economy. So at one end, the investment boosts jobs and GDP. That's the investment in low carbon technology, and the technology is capital intensive. But at the same time, there's loss of output due to loss of fossil fuel production, transformation, transportation, and so on. And there's loss of investment in the supply chains. And lastly, there's also an important trade balance effect where the importers are getting rid of expensive imports of fossil fuels, and the exporters, meanwhile, are losing these imports. Now, the importers are Europe, China, Japan, India. The exporters are places like the US, OPEC, Canada, Russia. So there's sort of that mirror picture emerging. So here are some traces for macroeconomic outlook. So you've got at the top government royalties that are lost, and this is income from that governments get directly from the extraction of fossil fuels. That's lost, and that's less income for government to spend domestically. So that has a large macroeconomic impact. And then you've got GDP as a percent change between the EU East Asia net zero scenario against the investor expectation. And you've got, it so appears, Canada being really the worst off around the world and the USA next. And that's because of how much of a contribution the oil and gas industry has, and how much ramification it has through the supply chains at the heart of the country. And that then has an impact on employment that is very important. Now I can zoom into this a little bit. There's two patterns that we see emerging across the world. There's the exporters and the importers, where the exporters see losses in the oil and gas extraction and heavy industry, not some gains in construction, and that's to do with low carbon investments. But overall, you see the services are declining, and that's because the services are a bit of a barometer for what's going on across the economy in terms of people's ability to spend. Now, the importers seem to have more benefits from the investment than the loss in their fossil fuel industry, while the exporters have higher losses in their fossil fuel industries than they have gains from the low carbon investments. So that's sort of the division and the structural change that we could expect to see across the world through the transition. But overall, for the whole world, these things roughly cancel. So at the level of global GDP, the effect is not very large. Ultimately, it's a distributional issue that appears across different countries. And here's for Canada. I've reserved sort of this chart, and please ask questions about this at the end if you like. I think for Canada, when you look at the data, it's very much an exports-driven story. So Canada loses exports. You see the second column. So here I'm putting the three scenarios as rows, and output, exports, employment, and consumption as columns. This is in million US dollars. So Canada loses massively on the exports of fossil fuels, but not much the other sectors. But that then, in terms of output, leads to loss of production, of course, in fossil fuels, losses in the heavy industry, but also loss in the services. But the services are really to do with the general loss of income across the economy and changing spending patterns by people, effectively due to the change in employment. But the problem is that when there's loss of spending in the services, there's loss of employment as a result of that. So that multiplies itself, and that leads to some difficulties. And there's also, that can be seen in the consumption modeling that we do. So that's just like my last slide here before I hand over to Gregor. So what are the ways forwards? And I'm happy to have that sort of discussion afterwards and see people's views and facts. I'm not used to studying Canada in particular. I'm more versed in the European picture at the moment, plus China and India. But what would appear to be perhaps a way forwards for Canada is to reduce the exposure to losses from oil and gas in the economy, both from the sort of production output perspective and the financial perspective that Gregor is going to talk about in a moment. So the reason is, as the sector goes into difficulties, there's going to be possibly enormous cycles and instability in prices. And we've seen that quite a bit this year, where there was, for a moment, a negative oil price in the spring last year. And this comes from overcapacity that recurrently can appear if the demand's not there to meet. There's just too much oil around. Now, that means that the economy, if it's too closely tied to the price of oil, goes through those swings up and down. While instead, if the economy was oriented differently, then it could be protected from that. So that would mean that there's sort of a diversification issue that needs to happen eventually, and perhaps before it really starts to be more difficult on the macroeconomic level. So creating jobs in new sectors, low carbon or not, and new industrial capabilities. And perhaps importantly, to look at regional developments to avoid the sort of self-reinforcing economic decline you can have in areas that are too focused on certain activities that are gradually being phased out. And I should just emphasize, the loss of economic activity is not completely just due to Canadian policy, because it's due to the climate policy that's being adopted by countries outside of Canada. That is, for example, in China. If China reduces its emissions, it affects the world's oil market, then affects Canada. And therefore, if China is going to go down that route, then Canada needs to diversify its economy. That's essentially what we're saying. And then there's India coming, and the whole of the EU, and the world may well transform relatively quickly from now on. So that's it for me, and I'll just hand over to Gregor.
Thanks, Jean-François. I'll just start my slides here and share my screen. So as Jean-François was saying, the energy transition has a financial dimension, and for some reason I have some under subtitles. Oh well. Now I will speak a little bit to this financial aspect of the energy transition and perhaps hope to convince you that it is relevant. I'll keep my remarks very short so we have time to discuss this and especially also what you've already seen. My presentation is grouped in 3 short sections, and I'll start by giving you a feeling for this discussion around the financial geography, then show you a little bit of data for Canada as a sneak preview. This is all unpublished research, still in progress, and then say a few words about the method for translating losses. But I will briefly try to disable these subtitles because they make me a little nervous. Sorry about that. Yeah, I hope this is better now. Sorry, that never happened before. Okay, I think we're without subtitles now. Transition costs for investors have become something that central banks and financial regulators have become quite worried about, because the transition not only changes the value added, as Jean-François has shown, but also the valuation of companies that are operating in the space. So the stocks are affected, monetary stocks. The mispricing of assets that these companies own is at the root. So if expectations change unexpectedly, and investors change their mind that the future maybe looks more like a TDT scenario as opposed to an investor expectation, as we call it, scenario, or even worse from the point of view of these companies' valuations, a more powerful mitigation scenario, then the net present value of assets can change rapidly. Now, there's an allied dimension that again goes back to flows, that the cash flow can also change unexpectedly for these companies, which can lead to bankruptcy and issues in the debt markets. So we have both market and credit risks, and all of that can have potentially systemic consequences of financial instability, which is clearly an important topic. Though I will say that the research I'll present is exclusively about company valuation. So the debt side of this is not part of the current research. Now, where we're making a contribution is that typically studies estimate stranded assets, the magnitude of these stranded assets, or their impact on the financial system, but not both. So there are no integrated models of how climate change scenarios that are realized can impact ultimately the wealth of financial investors. It so happens that we just published a review in Wiley Interdisciplinary Reviews of Climate Change, so you can read more about that there. Here I'm putting it all together. So we're starting with baseline scenario expectations, change these to a policy scenario expectations under which prices and demand fall, as Jean-François showed, which leads also to a reduction in global revenue. Now, this is really what you have seen in the first part of the presentation. And the second part is basically a network model that allocates these losses to specific assets, then to particular companies that own these assets, and then to financial companies that own these, at least parts of these companies, and finally to ultimate owners. And there's also the channel of assets under management, where financial companies just manage funds. You know, your typical pension fund would be managing expectant or already current pensioners' monies by managing them, the losses really directly are incurred by the ultimate owners. Now, I will focus for the rest of this presentation on this ownership chain and how we exactly allocate global revenue losses to specific assets is something we're currently updating, but the current assumption is that it's a pretty conservative picture for Canadian companies, because we're assuming lots of international participation in Canadian oil exploration under an investor expectation scenario. So whatever I'll show you now is conservative loss estimates for Canada, I'm afraid to say. But basically we have these 4 stages. Now, how does this look for Canada? And one other way in which I'm not being conservative here is I'm showing you a stress test scenario where we're moving from the investor expectation, so the robust growth in demand for fossil fuels, to a net zero sellout scenario, which is really the worst that could happen to Canadian producers. What you can see here is that at stage 2, there are Canadian headquartered company losses amounting to roughly $250 trillion. $billion. The exact magnitude is less relevant here for me than the distribution as we move from stage 2, headquarter losses, to financial investor losses. And based on our data, which is the Orbis network of ownership that tracks ownership globally of companies, most of the losses actually stay within the oil and gas sector. The legend is always to the right of the bars, which means that there is no financial intermediary that owns these oil companies. And so the loss is really owned by individuals who are owning these oil companies directly, oil and gas companies. The financial sector is very small in Canada, which is good from the point of view of amplification, because these companies essentially then also declare a loss in their valuation. But you can see that a significant share of these losses is actually assets under management. So funds would be taking a hit here. Finally, the overall magnitude of losses decreases because part of Canadian companies are owned by investors from abroad. So the net loss in the financials of the companies is actually bigger than that of owners that are based in Canada. Now, ultimate owners are mainly these individuals that are sitting behind oil and gas companies. You can see that the fund loss is slightly increasing, which is due to the fact that Canadian pensioners or wannabe pensioners also incur losses from losses in production abroad. So Canadian pension funds are essentially invested abroad in fossil fuels. So, and the government has a very small share in these losses. Now, if we compare this with the US, again, I'm more interested in the relative size of these graphs than the absolute size, although you can see it's very large. By the way, these magnitudes here are on the order of 10% of Canadian GDP, which is a flow, and that is a stock loss. And here we see that in the US, actually, financial losses far outweigh headquarter losses because of the large financial holdings of US financial companies abroad. At the same time, moving from financial markets to ultimate owners, the loss to funds is greatly reduced because US fund managers manage funds from individuals abroad to some extent. So these are the kinds of results we generate. I'll just add one more, which is that we can, of course, go to the company level and compare the shock that companies incur to their assets with the equity that is currently reported in these companies. And what we see here is only companies, every observation is a company where the shock that we calculate, net present value of losses over the next 15 years, that results from moving from one scenario to another, in this stark fashion, from very sanguine expectations to extremely optimistic expectations about climate change mitigation, we see that more than 100 companies in Canada, according to our data, incur shocks that are larger than their equity. So they essentially have a negative equity. And you can see this is a log scale here, that for some fairly large companies with debts, in the order of $1 billion US, have shocks that easily exceed their equity. The darker the color, the higher the leverage, meaning the smaller the equity relative to debt. And so basically, there is a debt of more than $85 billion US in companies that incur these very large shocks. Now, this is not about cash flow, so we cannot say anything about whether these companies can repay their debts. But given that they are losing all these assets, it clearly means that going forward, also their cash flow is reduced relative to what they may have expected. So this is essentially the link to potential financial instability, which, it's very hard to get data on that, so it's difficult to move the analysis from here. Now, how do we do all of this? Okay, well, basically, we use a network model that connects these rigs to headquarters, and we just allocate these losses from rigs to headquarters by using the ownership share, which we can compute from the Reichstad database. Whoops, what's missing here? Nothing. Now, when we move there, we need to do some adjustments for the fact that headquarters do not keep all the revenue, but part of the revenue is cost to them for suppliers. Basically, 30% of the 100% loss actually is transferred to suppliers, and both headquarters and suppliers have a wage bill. So we are only looking at the 60% of the 100% loss in revenue that actually accrues as income to capital owners. Now, how does this look in terms of different behaviors that Jean-François described? Well, it makes a big difference. For instance, here I'm focusing on Iraq. That is fairly high in the ranks of countries that have stranded assets. But if OPEC decides to do sellout, they drop from the map of the 30 biggest losers of assets. Whereas Canada, on the other hand, is, again, under these conservative assumptions of who operates in Canadian soil, Canada moves up the ranks because under the sellout scenario, it's harder for costly Canadian oil and gas to compete in the market. Now, step 2 to 3 and also 4, basically losses from headquarters to financial companies and ultimate owners, is really just a propagation of a shock through a network model that we populate empirically from the data from Orbis. And basically, we run the model until all the shocks are distributed to leaves, so there are no more ownership connections, and we do not amplify it at all. We just pass the shock on to calculate net wealth loss propagation. And these leaves can be corporate ultimate owners because we don't have data, but of course we can allocate that data also to individuals who must be the ultimate owners of corporate entities. To keep in mind, all this assumes a particular baseline and policy combination, zero stabilization policy, by that I mean macroeconomic stabilization policy, zero financial upside risk from low carbon investments, which could hedge the investments of individual companies, and thereby also change the picture that I showed you about the shocks being larger than equity. And also zero climate change physical risks, which could have an impact, of course. So there's plenty of space for policy to mitigate these risks. And in conclusion, Canadian companies, shareholders and fund investors, think of pensioners, are invested in companies that could sustain losses to valuation. Whoops, I wanted to show this. Canadian ownership structures look like the government will actually sustain a very low hit because it's not really invested in these productive sectors, unlike, for instance, in some OPEC members which have national oil and gas companies, but there are large individual shareholder losses. And some companies risk losses that are large relative to their equity, which raises questions about cash flow and stability. Now, energy transition trajectories could benefit from taking these financial risks into account, but for completeness, they should also consider upside risks from investing in low carbon alternatives, which could also be, an incentive for pushing for these kind of investments to be made so that financial investors can actually diversify their portfolios. I'll stop here. Thank you very much.
Well, thank you. Thank you very much to both of you. That was quite an interesting presentation, although the conclusion may seem a bit bleak for our future, and that could explain why people are not asking any questions. Are everyone crying in their corner? But if I may, I would start with a question if no one else has a question right now. We see that in well, I will ask it quite bluntly. Should we still make those scenarios where we consider that the demand for Canadian oil will stay the same in the future?
Yeah, it's becoming increasingly tenuous to think that at least one should really consider the very strong possibility that demand would not be there anymore, and be prepared for that, and not rely on, say, the price of oil recovering or the demand recovering, especially after COVID-19.
Yeah, thank you. So there's a comment here, maybe not exactly a question, but the result seems to critically depend on regional relative supply cost curve.
Stephen, do you want to ask the question directly?
Can you hear me?
Yes.
Oh, okay. I was just going to say that you don't have any uncertainty in this, the way that you presented it. I assume that you did model some uncertainty, but nonetheless, the results that you have are talking about regional differences in supply cost curves, which can change over time and are somewhat unknown as far as I know. And so I'm wondering what you did to consider this this critical aspect of the modeling that really kind of drives the results for Canada. Like, is what you're saying really fairly, well, I don't know, maybe it's obvious what I'm saying. I'll let you try to respond. Jean-François.
Yeah, sure. I mean, I appreciate, and that's true. I think I'll list the main uncertainties, perhaps. One is the cost of transportation and the possibility of some new trade regimes where, well, during the Trump years, perhaps we could have thought it was like, we could have imagined it to be not unlikely there to be some new trade restrictions in relation to energy, but now that doesn't seem to be happening. There's, of course, the data itself from Rystad and the costs and the way they are reported. There's uncertainties with that, but the differences are quite large. So even if there was lots of uncertainty over these values, the difference between Canada and the overlap between Canada and the Middle East is not very large. So I think that's fairly well established. I think we know quite well what's in the Middle East. What's in Canada, there could be improvements in technology that could bring those costs down. But I think that we've seen some of that happen with tar sands, and to a limited degree that still requires prices to be fairly high for tar sands to be profitable. And of course, there's this whole shale oil question. And so I think ultimately it's reasonably robust against those uncertainties in that the differences are fairly large, so that it wouldn't make a huge difference if we assume quite different numbers for the costs. There's uncertainties about the pace of diffusion of technology. We're relying very much on the current observed pace of technology diffusion. And of course, there's all sorts of things that could come in the way of that. I should just specify the diffusion of electric mobility is what really screws the oil markets, while renewables mostly affects power generation and gas markets. And so if there's anything that slows down the rollouts of electric mobility, then that's going to give a bit of more space to the oil market and take longer until these difficulties arise. I think that would be the main uncertainties.
Maybe I'll just quickly jump in here and say that, you know, I focused here on showing you one scenario in terms of the financial losses, but in fact, we're always looking at a set of these behavioral scenarios. And so to some extent, the behavior substitutes for uncertainty on supply costs, because a quota scenario is more accommodating of higher cost producers than a sellout scenario. Sellout meaning OPEC packs the market as they can, or not OPEC, but low cost producers. So clearly there, we see shifts in cost, and I showed you that in the last graph from that financial perspective, which of course carries over into the macroeconomic perspective. Just one point still on the scenarios and also on all of this. I mean, we're very aware that there are lots of assumptions in our output. And I found it helpful from some financial sector listeners to an earlier version of this presentation, who were saying, well, we're glad about any data point. We're trying to collect as many scenarios as possible. We don't really believe any individual one, but you know, we're trying to see what's plausible out there. And so in that sense, I think it's also useful to have a high demand baseline scenario, but perhaps not as the only baseline scenario. And you know, perhaps you want to ask yourself, from whose perspective are you thinking about this? Is it perhaps an oil company that needs to kind of keep an optimistic outlook, or perhaps does not, but has had, so is stuck with that for some time? Or are you looking at this from somebody who already has changed their beliefs about that, in which case the TDT baseline might be more useful?
Can I sneak in another question?
Yes, please.
Okay. The other question I had was, this is more for Gregor. I don't know if you thought about like expectation swings and like what your model is tracking out, and then what investors might track out as net present value of a firm. And so the thing is, like, temporary swings in finances potentially can affect companies, and so you had don't circulate this stamped on certain slides, and there's a reason, right? So like I was wondering, like, do expectation swings? Did you consider expectation swings and how that kind of plays havoc on companies, or is this such a long run thing that you just don't even worry about expectation things because you're just going to move to fundamentals, if that makes sense?
So also another question in the chat: when will it be reviewed and published? Reviewed, hopefully very soon. Published, ask the editors. But the financial side is still work in progress, and the don't share symbol is mainly because this still needs to go into the journal, and it's new knowledge, new information. So we basically were taking a long-term perspective, and we're saying, well, suppose eventually expectations change, then relative to those new expectations in the future, how are assets mispriced? But of course, you're right. I mean, there could be lots of swings in expectations in between, which we do not take account of. And in fact, we have a very simple depiction of expectations, which I mean, that's an exogenous aspect in our model. We say, well, we're just comparing two scenarios. What's the difference in revenue? We're not forming any opinions on the sort of timing. I mean, we're saying, you know, if you look at this from now, what would be the timing? By the way, if we push the whole thing out a few years into the future, it gives very similar results. But of course, then the empirics of the ownership have become more tenuous. So all we're trying to say here is that this is the kind of loss that is incurred from that shift, but we're not taking a position on how individual investors take advantage or disadvantage of that. And we're also, I mean, that would be important to know for feedback into the real economy, which we're not modeling at this stage. It's very difficult. That's for sure, to get this right.
Yeah, it was just saying that, you know, like you could prematurely can some companies. Like you could meet your scenario, your deterministic scenario as you wanted to potentially, but depending on how information flows, you can, you know, have severe impacts on certain types of producers. But thank you very much for your presentations and answers.
Well, I thank you for your questions. We still have a few more minutes. If anyone has any questions still there. Yeah, Bentley, I think you have one.
Thanks for this work. It's really important. Jean-François, could you maybe help me get a sense of what's driving the losses in employment in your really striking graph towards the end of your presentation there, whether it's the macroeconomic model in the trade balance that's doing the work, or whether it's actual effects on fossil fuel companies, or what is it that's driving the decline in employment in the model?
Yeah, well, so for Canada, it's export driven. Export loss then means loss of output in oil and gas, but then that means loss of output in a whole range of sectors, whether it's machinery, vehicles, manufacturing, construction, and then the loss of income in those sectors means there's an effect on disposable income across the economy, and then there's a loss of spending, loss of in the services and all across the economy, in comparison to the scenario where this doesn't happen. Admittedly, perhaps the investor scenario is a bit of a straw man, where we have too fast growth for the Canadian economy in relation to how much exports they are expecting to get. And then we're taking this as losses, so the numbers appear quite low, right? Now, if I took the differences between, say, the current trajectory and, say, the net zero scenario, then the differences are different. But they're always quite large. And what's to remember is that ultimately, there's a large amount of outputs in Canadian oil and gas that, if that disappears, a lot of dependent industries also disappear. All of the construction, the investment that we're going to happen in those sectors disappear, and because they haven't had time to readjust and sort of reorganize their activities towards other industries, for example, renewables, then those jobs just disappear. And we have to remember that this would be quite regionally concentrated. Like maybe not that much happens in Montreal. A lot of it happens in the Midwest. I mean, that's sort of probably fairly self-explanatory, but you can imagine how some towns in some areas could see a lot of loss of economic activity, while other towns might not be affected at all.
And can you say something about the effect that it seems that the job losses are the same across all three scenarios? Is that the case, or is it just that the resolution of the graphs that we're making it appearing so?
Yeah, that's interesting. I suppose because Canada is the first in the list in terms of losing output in fossil fuels, then a lot of the loss happens before the other countries. So therefore, when you have the net zero, you have less of a difference for Canada than you would have for the US, for example, because a lot of the loss have already happened for Canada. I think that would be the explanation.
Oh, thank you. And sorry, Norma, I went over your question, but the answer by Gregor is in the chat. So
Yes.
So that's the first, yeah. So that's the first time that you were looking at a specific country. So we cannot compare those results with how we were compared to other countries like Norway, for example.
I should say in the financial space,
Yeah.
obviously not E3E, which.
Yeah. So we're a bit over time. So if some people want to stay, you're welcome to do so. But for the others, I will thank you all and hope to see you soon in other presentations we're going to be making.